It's a well-known statistic that SMEs, in terms of population, are responsible for the economic output of a country. So SMEs are 95% of those people who employ people and actually generate the wealth for the country. So if you work on that premise, both employment and wealth creation, then the question is, do they get the funding they need in order to help a country prosper? So funding is always something that many people say is responsible for their growth, but also for their demise. It's always been regarded that SMEs particularly struggle to get access to funds. And so today we're going to talk about how can SMEs, entrepreneurs, early startups, how can they get access to funding that allows them to grow, to employ people, sustainable communities, and ultimately create the wealth for the country. So I'm joined by two gentlemen here today who are going to explain that puzzle, how we can resolve that puzzle, how we can get a country's growth in a northward trajectory, and their role is to help those SMEs and businesses looking for funding, but actually they're not as traditional as one would think. So I'm going to go over to both Steves. I've never interviewed two Steves at the same time. I'll let both Steves take in turn to explain who they are and what they do and how they are going to play and have been playing a role for many decades in making sure that SMEs and entrepreneurs have access to finance to allow this growth to happen. So Steve, to you first.
Thanks, Ninder. I'm Steve Walker, Dr. Steve Walker. I am the Chief Executive of Art Business Loans. We're a CDFI, which we'll come to and maybe explain a little bit more later on. Established 27 years ago, and we make loans to small businesses and social enterprises unable to obtain their full requirements from banks as an additional source of finance. We lend between £10,000 and £250,000, and basically we only lend where we are supporting an impact in relation to the activity of the small business, and we lend in the West Midlands region and adjoining counties.
Steve?
Thanks, Ninder. So I'm Steve Deakin. I'm Chief Executive of BCRS Business Loans. We're based in the Black Country, and we cover the West Midlands and the whole of Wales recently. We've been around 23 years, and I'm really proud to say that since our inception we've lent £100 million to small businesses.
That's a lot of money.
Yeah, which is absolutely great. And similar to Steve, we lend between £10,000 to £250,000, and we also impact a big part of why we do what we do.
So Steve, you mentioned the word CDFI. That's a hell of a... So what is a CDFI?
A lot of people use initials and get lost in the world. There's a lot in the finance world in terms of initials, but CDFI stands for Community Development Finance Institution. It's a not-for-profit vehicle. It's not for personal profit. It's not basically profit for shareholders. It's effectively a social enterprise that has a mission involved in its lending. And the mission usually is targeting a particular area or a particular impact in relation to what it does. And that could be in job creation. But the main mission of CDFIs is to provide an additional source of finance where the banks have been unable to assist fully, to enable small businesses to achieve their targets and basically meet the needs of those small businesses. We do actually lend on our own, but we also lend with others in partnership. So it's not just our loan; it could be other loans. But we've been lending. We've lent just over £40 million over the years. We're lending around about £3 million a year. We're relatively small, but we would say that we make a difference to the people that we basically support.
So Steve, so Steve, the other Steve, I'm going to try and remember this up. So Steve, the other Steve was talking about social impact. Is that what drives you? Is that first and foremost what drives you?
Absolutely. So we're a not-for-profit, and what that allows us to do effectively is it allows us to employ really skilled people. Our team's got probably over 200 years experience in SME lending. That's just our lending team. And that allows them to work with the SME and go out and meet the SME and really listen to their story. So we often say we're a story-based lender, which means we can work with the SME to turn what would have been a no into a yes and provide that additional support. Also, we firmly believe that SMEs are a force for good, force for social good. So all of our lending really is about supporting that SME to grow their business and to have a growing social and economic impact on the communities that we operate within. And there's a great statistic that for every pound we lend, over £5 of extra economic value is generated in those communities.
And so, Steve, so typically, if I think about a big bank, they're funded by institutions, shareholders, and that's where the money comes in, then they filter it out. And so where does your money come in that allows you then, and we'll talk about disadvantaged communities in a few minutes, where does your money come which allows you to do things that maybe the major lenders, you said, and we'll talk about why the major lenders wouldn't lend. So where does your funds, where do they come from?
Well, originally, when we started all those years ago, which was then called Aston Reinvestment Trust, we actually tried to get money from the public sector. And so therefore...
Government?
Government and local government, regional government. There were in those days, there were area regeneration areas, because you touch on the subject there of targeting underserved areas and communities. That's exactly what CDFI does. We target them. We don't necessarily lend fully to those, because we're basically lending to businesses that have hopefully got viable and growth prospects. But we do target underserved areas and communities. So there was an interest all those years ago, and that's it, as we came from sort of an ideas that were developed in the States targeting underserved areas and communities. Then at the end of the day, we were looking for money from the public sector. We actually started by raising money from the private sector. Our original backers were two of the largest banks in the UK, Barclays and NatWest. But to raise the capital we needed to lend, and we only lending in a small way to start with, in inner city Birmingham. Our name was Aston Reinvestment Trust. It gives the game away, even though we sit in Aston again today. Basically, that's where we've always been located. We really looked at positions of underserved areas and communities in there with the areas of disadvantage originally. We're now wider than that. So the money, you asked the question where the funding comes from. It is a mix of public and private sector funding. Over the years, the public sector, national government have supported it through schemes, the Phoenix Fund, Regional Growth Fund, and we've had support from local authorities, we've had support from regional development agencies, and now we're potentially on the cusp of having a larger amount of support coming from national government. But it's still a mixture, and we have got also shareholders who invest in us and get a tax relief, little known tax relief, called Community Investment Tax Relief. I can tell you about that because you're one of our investors and received this CITR. And we thank you for your investment, and others who have individuals and companies who invested in what we do and believe in what we do. And we've never lost any of our shareholders' money in 27 years.
So Steve, I know BCRS originally started with money from local government. I know that, local authorities. Why would they give you money in order to help SMEs? Why would they give money over to you?
I guess because they haven't got the expertise themselves to run a loan fund, and it does need quite a lot of expertise. So they recognise that actually to run a loan for themselves, they'd probably end up losing all that money, so that they'd then go with an organisation that was specifically focused on lending to SMEs to disperse that money in the way they wanted to for them.
Why would a local government even want to get involved in financing local businesses? What's it to do with them? There's banks out there. Why would they even be in that space?
There are banks out there, I guess, but the banks take a different risk profile to us, which I absolutely don't blame them for, because they've got the pressure of shareholder return, and as a not-for-profit we haven't got that pressure, so we can take a different risk profile. So local authorities saw that there were gaps and there were SMEs coming to their growth hubs, or whatever the growth hubs were called back in those days, and saying there's this problem out there, and then they found partnership organisations like BCRS and ART to work with.
So they saw in their local community market failure, So there's lots of these ideas, lots of entrepreneurs who didn't have the money to grow, and ultimately tax take means they need rates, they need money. So without the local economy growing, your local authorities thinking, we're in trouble here, we're not going to grow this. So if the banks aren't doing it, market failure, we'll jump in. We haven't got the expertise to do it. So we'll turn to people like Art and people like BCRS and say, here's a pot of money, you now help us to regenerate the local economy. Have I got that right?
Yeah, I think that's pretty much it. And also it's a really good use of taxpayers' money, because you're not just giving grants to those businesses that you'll never get the money back, you're giving loans to those businesses. So effectively that money will be recycled and lent again. I think we're on about our 7th loan from the Staffordshire County Council.
But I think also, though, that things have changed a little bit in the last sort of 10 years, because when we first started, we would have done, and I think Steve was the same, we'd have done a few startups, but now the government have got the startup loan scheme. Now, we both don't operate. We refer people to the startup loan scheme, but it's government money at a lower interest rate to encourage that. So the local authorities don't necessarily have to get involved at the startup. But the biggest gap is, how do those startups scale up and get their next scale? That's where they would then be coming to CDFIs, and that's where I feel the local authorities came in, certainly in the case of Birmingham. And I suppose the other thing that's changed over the years is the local authorities haven't got as much money as they used to have, which is a slight problem. But at the end of the day, they would support and that growth aspect. And growth is the big word, and has been for probably the last 2 to 3 years in our market as well. And one thing I should have mentioned earlier on is that the other most important feature that helps us from a national point of view is the guarantee schemes that we're able to adopt to. They've been, over the years, there's been the enterprise guarantee scheme, in COVID, there was the CBIL scheme, the RLS scheme, and now both of us are accredited by British Business Bank for the growth guarantee scheme, and that's what we're currently on. Without that guarantee scheme, we probably couldn't do what we do.
Right.
Could I expand a little bit on the
gonna
funding as well, Ninder? So I think there's been a couple of other changes over the last decade. So firstly, British Business Bank was set up. So whilst the local authorities had to take that role previously, the British Business Bank, as the development bank of the UK, then took over that role. So they've set up the Startup Loans Company, which is, whilst Steve and I don't deliver startup loans, a number of our CDFI friends across the UK do.
Yeah.
And it's a really good product for startups. They've also set up the regional funds, which we're delivering the second iteration of the Midlands Engine Investment Fund for them. And I've also moved into Wales to deliver the investment fund for Wales. And I think the other thing British Business Bank is very keen to do, and probably as a sector we're keen to do, is get more commercial funding. So I'm really pleased that this a year ago, Lloyds Bank came in and funded BCRS along with 2 other CDFIs, recognising that with the shareholder return Lloyds Bank have got to make, they can't lend to the risk profile that we lend to, but they should support those customers in another way. And the other great thing that Lloyds Bank are doing as a result of that is they're about to launch a pilot referral scheme to the whole of the CDFI sector. Because we used to get probably 70% of our referrals from the banks, and since the introduction of the national bank referral platforms, that's diminished to pretty much nil. But Lloyds Bank have recognised that, and they're working a way to go around that. So one of our asks probably of the government is to support us in talking to the other banks to show them what Lloyds are doing and encouraging them to do the same, whilst also looking at the referral platforms and making them fit for purpose so that CDFIs do get referrals. So we've only had 7 referrals since the bank referral platforms came into place. The last one was in 2021. I can't believe that there's bank declines that shouldn't be coming to CDFIs. I don't know where they're going.
Yeah.
So we'll pick that up a bit later on, as how people find you. Just picking up the role of the British Business Bank, I don't want to go into too much detail on it, but the British Business Bank is obviously set up by the government. So that means the government at the national level, not just local level, but the national level, realises there's a market failure and a funding gap. So they set up British Business Bank, who then give people like yourselves the money for which then you lend, correct, to SMEs. So that's partly the question I asked earlier, where does your funding come from?
Yeah.
So really it's through national government, through Business Bank, and partly through local government. The reason I'm stressing this is that SMEs and entrepreneurs need to realise that outside the traditional 4 banks, or 5, and the challenger banks, there are people like you who the government recognise are a credible source of lending people money, and that entrepreneurs, and I've been there, where I must admit, when I didn't know about yourselves, is when you're right at the edge and you don't know where to turn. And we'll talk about digital in a few minutes. And immediately what people do is they go to the digital websites and think, I need some money here quick. And then they're paying extortion amounts of money. And they don't realise actually there's a government-backed organisations such as yourself who actually, and the problem, and we'll talk digital later, the problem with digital, it is digital, there's no people involved. But actually you have people that will help. And I think the brilliant thing people don't realise is your social impact. But we'll come to that in a second. Right. So the 4 big banks then, or the 5 or the 6, how many you want to call them, are they your, I'm hinting, you've just hinted, Steve, that they're not your competitors.
No, absolutely not.
You work alongside them.
Yeah, completely the opposite. So for us, it's job done when a customer goes back to the bank. They might not hit the bank's credit scoring system when they come to us. And often it might take a couple of loans from us before they do. But once they do, it's job done. They're back into mainstream finance. There's no doubt it's cheaper because it's less risky. So we always want to do the right thing by our customer and get them the most affordable finance they can get. So yeah, absolutely. We're almost building the bank's pipeline for the future.
And when we basically also, I mentioned earlier on, I mean, it's so important to recognise that we are different from the online and the alternative banks, alternative new banks that have come on, because we are an additional source of finance. We are lending after the bank has basically declined. That's what we're lending. And Steve made a very valid point that we would like to see more of the ones that the bank had declined to see the opportunity to help. That's what we really like to do. But it's an additional source of finance. So we're not no way in competition. And over the years, some of the banks, and Lloyds are now recognising it very, very much in this moment, but really early on, NatWest and Barclays recognised that. That was 27 years ago. They recognised that they couldn't do, and the world has changed so much because the banks have moved away over the years from lending to the smaller businesses, to the more difficult risks. And having moved away, what's replaced them is not necessarily been the likes of the CDFIs, it's been other alternatives who are in competition. And we'll come to that more when we talk about the sort of digital world. So it is different. I mean, we've been lucky. We've been supported by a bank who understood what we were doing, Unity Trust Bank, which is basic, and Steve had funds from Unity Trust. We've also had money from America because there's basically from a company as a loan for capital. This isn't to pay the wages. This is actually money lent to us like a bank would, lent at a social investment rate, and lent to us to go on and lend and give us the ability to lend. And that is where, over the last few years, that's what most of the CDFI sector has cried out for, that certainty of having money so that we can go out and scale up ourselves.
So if we come back to the role of British Business Bank, which is where you started this segment, Ninder, what they've done is this last 12 months or so is absolutely brilliant. So they've set up a fund called the Community Enable Fund, which is going to be £150 million funding pot for the whole sector. But what they've done alongside that, along with Responsible Finance, our trade association, is they've worked to encourage other organisations to come on board and support the sector through grants to upskill our people, upskill our systems, put new technology in, new marketing approaches, and we're very privileged at JP Morgan of giving the sector overall a £4.5 million grant to help scale up the sector and deliver that 150 million. But the premise of that 150 million is very much they will then get the banks to crowd out that 150 million. So we will get commercial loans from the banks to lend to those customers that they're unable to support, and then that will give us a constant long-term source of capital. It's one of the real downsides of being a CDFI and a chief executive of CDFI is every 2 or 3 years you have to chase the next round of funding. Whereas if we can get a constant source of capital, we can then really concentrate on scaling up our operations and getting the message out there.
Probably do ourselves out of a job.
So let me just summarise this a little bit then. So we're talking about what makes you unique then. So what's unique is that, interesting, you work with the major banks, so you don't compete with them. You target a market that is underserved. In other words, they don't have the chance to go to the four big banks or the five, because they say, sorry, you're too risky. So it's a bit like the umbrella job. So they turn to you. But what's interesting is, whilst you're funded in a different way, but actually you measure success in a different way, because you don't have to give money back to shareholders. Your job is to get a return on it, because that's how you then lend. But you're measured by what you do socially, and I think, and we'll talk about the digital next slide. So have I got that right? And so you're serving communities that typically wouldn't get funding. Is that
I don't know. No, I think it's. I think probably the original premise of CDFIs was that we would be serving particularly those, but it has moved on. Well, and we're serving effectively a gap. And I would say now that I would probably want to see the banks do something for the businesses, but not do necessarily all that the business needs. And I think there's more of that, and what we've moved into. It's still, we target the underserved areas. I think we should probably define for people listening what underserved areas really means. It means underserved areas in terms of deprived communities, disadvantaged communities in terms of index of deprivation. That's very technical. It means businesses that perhaps are led by women, led by ethnic minorities. That's what it is. And 75% of the businesses that we lend to have to be in those areas to enable us to give the community investment tax relief that we give to investors or banks or lenders to us. So that's we target that, but that doesn't mean we exclusively are looking at that, but we do target that.
We definitely have a focus on it, I'd say. So I think Steve's stats are fairly similar, but correct me if I'm wrong, Steve. But last social impact report we produced, 18% of our lending was to female-led businesses, 18% was to ethnic minority-led businesses, which is pretty good when you compare it to a lot of the lenders. So I think because we've got that ethos, whilst we don't directly target it, it kind of happens organically. I think the other thing to build on, which perhaps we haven't mentioned yet, is we very much have an ethos of all our lenders live within a commutable distance of the communities and areas that they lend in, which has a couple of benefits. From a risk perspective, they understand those areas and they probably understand what the risk of businesses is in those areas. But also from an impact perspective, they really care about those areas and they care about where they lend, and they really want to lend as much money as possible in those communities. And I think that's a real benefit of being a place-based lender.
And I think the knock-on effect, when we first started, I can remember going to an area of Birmingham called in Kings Norton, where there were 3 very disadvantaged estates, and right at the beginning, and there was a completely derelict shopping centre with about 12 shops and only 2 units taken, and nobody was putting money in. Nobody was interested in investing, and we actually invested in 2 of them, and all of a sudden it was the example of investing in those 2 that all of a sudden some people said, oh, if there's people coming in, we'll have a coffee shop here. And that for me is part and parcel of that social impact. It's not necessarily the loan to the business, it's the knock-on effect in that particular area, the encouragement and the opportunity that it gives to that area, and say somebody's interested in us.
So it can generate a place.
Yes.
A place can be generated, and suddenly the whole community benefits from all the income that
Yeah.
sort of. Digital. The digital revolution is with us. It's affected, and I speak as someone who ran a record company, still run a record company, but we were decimated by the move to digital, where people started to download rather than buy physical CDs. So we now go on the high street, and it's very rare you can spot a bank and a branch. It's very rare now.
Yeah.
I can't remember the last time I've either written or seen a cheque. I think
That's very mean of you.
yeah, I think a lot of people will complain that their relationship with their bank is transactional, because it's digital. They don't talk to them. They don't get phone calls. So for yourselves, running something that is so aligned to society, communities and people, how has the digital revolution affected your operation then? Bearing in mind that just that big picture I've given you about the way society is moving, how did you have to react to a digital? And by the way, digital also means you've got people now selling what you've got digitally as well.
Oh, very much so.
Yeah, so it's a really interesting question. So there's a couple of strands to it really. So firstly, when new digital lenders come onto the market, they probably lend in our market space for a little bit just to gain traction, and then they soon go up the ladder and still leave that gap in our market space.
Yeah.
Or if they don't leave the gap, they charge quite a high rate. I think there's a bit of a myth that digital lenders will turn round loans quicker than CDFIs can, whereas actually if we get the same information that they'd upload to a digital platform and in the high risk profile, we're equally as quick. If you're a low risk proposition, they can turn it around really quickly because they don't need as much information.
No.
And I think the other thing is you can get a really quick decision, but you're going to end up paying for it, because what the real quick lenders will do is effectively charge you 36% a year plus interest rates to balance off the risk of making that quick decision and not assessing the application properly. So I think there's that point. And then I think on the people point with the banks, it's something we don't shout about enough as CDFIs, and it's probably one of the things that makes me most proud when the team's in the office. You're over here kind of one of the business development managers having a conversation with someone recommending a pension advisor or an accountant, or just sometimes chatting to the business about a problem they've got. So having that human interaction that's now been lost at the smaller end, unfortunately, because there's a call centre approach. There's not that kind of dedicated relationship manager. So I think that's an important role we play, which we don't get paid for, but is exactly the right thing to do. And because of our ethos, because we're not for profit, because impact and community is important, it's absolutely vital that we play that role.
I would endorse that. I mean, what the difference that CDFI in its approach is that we want to go out and see the business and understand the business and understand the people. When you make an application to someone online, you might be getting that speedy response. They might be looking for the speedy response because you're so busy. The small business person is so busy at work, he hasn't got time to show someone around the premises or talk to them about the business, and that's what they're looking for, which is sad in a way, because at the end of the day, they're going to gain a lot more from a person, an interrelation with someone who's got experience, and as Steve said, might be able to lead them even into the world of the wonderful world. It's not often I actually use this word, wonderful word of there might be a grant available for you to do this. I don't use that word very often, by the way. But at the end of the day, you might know about it because of our local knowledge and because of the connections we've got. We might know someone who can help them in those particular areas that Steve mentioned. And I think that's the difference that we adopt. I think that there is a real major problem. Steve has hinted that some of these digital lenders are lending at a higher level, but I'm worried and concerned that the word Wonga comes into play, which was for the consumer thing. But some of these interest rates now are way into the ether. But it's not just the interest rates; it's the fact that they're looking for repayment over 2 years. Now, if it's 2 years and you're borrowing, say, 100,000, and
lot of people
a
to pay.
40% interest rate,
a lot to pay back.
that's a lot to pay back. You've got to be doing really well. And some of these businesses hopefully aspire to do that well, but do they do that well? And that leads them into trouble. And when they realise they can't, they've damaged their business to such an extent that they then come back to the likes, through brokers perhaps, or other. They come back and they're seeking money from CDFIs, and it's too late because they've damaged their business.
Yeah, that completely resonates with me. It's one of my pet hates when we see a credit application to effectively refinance a higher cost lender, and we absolutely will when it makes sense, but sometimes it's damaged the business to that extent that it's not viable anymore. Yeah. And that's just, it's heartbreaking really. It's
So let me just summarize. So we've got on the one side high street banks who charge, they vary, depends on your risk profile. On the extreme side, we've got digital, who you have no connection with, and they charge up to 36%.
And higher.
And higher. So you sit in the middle somewhere. So what does it cost to come to you? It's not going to be as cheap as the high street banks, my guess.
Yeah.
It's not going to be as expensive as the digital where you don't. So where do you sit?
It's a fair way of looking at it. I agree with you. That is probably the best way of looking at it. We can give all sorts of examples of banks actually lending at a higher rate, depending on the risk profile. But we're in the region of somewhere in the region of about the 16 to 18% mark. That is the sort of area. Now, interest rates, as we talked today, of course, have come down.
That's right.
But you've got to remember, we have to get. When I try to explain it to people, and people say, "That's an awful lot of money to charge," but we have to actually get our money and pay somebody for our money. So that's the first start. We have to pay the overheads of our business, and then we have to cover an element of bad debts because we're taking more risk than the banks would take. So it soon gets to around about the 16, 18%. If you don't charge 16, 18% and you're charging lower, then basically you're probably going to go out of business. The thing is, the reason that we can do it as well is because of that guarantee, and that keeps the rates low because we've got a guarantee. It's a guarantee to us. It's not a guarantee to the small business. The business is still liable, but the British Business Bank guarantee is a guarantee to us, which reduces our area and enables us to charge a lower rate of interest.
So just to build on what Steve said, so we charge similar 12% plus base, so around the kind of 16% mark after yesterday's base rate movement.
Yeah.
But I think there's a couple of points to build on. We also employ very skilled people to work with the business, so we're kind of unofficially providing an advisory service to help them turn that no into a yes. We've very much got a culture of how can we make this work, how can we make this proposition viable. So that's factored in. As Steve said, the costs of our borrowing to then on lend to the customer has to be factored in. But I also think we're actually at the moment quite competitive in the marketplace, even with all the alternative lenders, and some of the better known alternative lenders we're probably cheaper because at the moment they're concerned about some of the kind of ups and downs of the economy, and it changes day by day, doesn't it? So they're pricing for a higher risk profile than we are, whereas we've always had the ethos of we will pick out winners from all sectors depending on how they're performing, even if that sector is considered a risk sector in the current economic circumstances.
I was going to say, how do you decide then, if again back to that spectrum, high street, digital, how do you decide, and this is important for people now as they prepare to come to you to say, we want to borrow some money, how do you decide who to give it to? What do you look for? And how can people best prepare? Because with digital, they're not talking to anyone. So the fact they're talking to people surely must help. But how do you decide? What's your criteria?
Well, first of all, when they go to digital or to any lender, people will have to supply information. And the very first thing that I would say to anybody who's approaching a CDFI, it's the supply of that information that is the most important factor. supplying that information and basically making sure it's available. And what we're talking about information, we're talking about accounts, we're talking about bank statements or open banking and availability of open banking. We're talking about history. We want to get below the people. We want to understand the people and how good the people are. But basically, we need that information. Without that information, it is very difficult to make a decision. What are we looking for? You asked the question. We're looking for a viable business that we basically is going to grow, hopefully, and basically is going to produce a social impact in terms of creation and preservation of jobs. But that is a minor factor, because the most important factor for us is that business is able to repay the loan. And so they've got to show how they can repay the loan. It's as simple as that in terms of how they can repay the loan, and the confidence that an entrepreneur has in their own business, their own market, and their ability to repay the loan will actually transfer to the lender, the business development manager. And if they haven't got the confidence, we won't have the confidence.
Yeah.
So Steve, so somebody walks through that front door, you already know they've been rejected by the high street.
Yeah.
You know that. So there's something that's a flaw with their plan, because they've been rejected at that end. So what do you see in them that the high street doesn't, and why are you taking a risk when the high street refuses to?
I guess there's a couple of strands to that. So why do we take the risk when the high street doesn't? Because that's why we exist. That's exactly why we exist, because we absolutely love SMEs. The whole team loves SMEs. That's what gets us out of bed in the morning. As you said, they're the backbone of the economy.
Right.
So we want to support SMEs to make their dreams become a reality, and then support the communities they lend in. I guess the trust thing's really important. So one of the things I was going to add to Steve's point was, if there is something in there, and there will be something in there because you've been turned down by a high street bank, be upfront from the start. Because if you don't mention the thing that's wrong, and suddenly bring it out at the last minute, that trust piece goes. And as a lender, we need to be able to trust you, because we're risking our money to support your business. So don't be afraid to say this thing's wrong, because we know the reason you've come to us is that the thing's wrong. I think it's worth pointing out as well that, yes, we do need information, but we recognise that a lot of SMEs won't have a dedicated finance professional within their business. So we will work with you, and we will work with other advisors, and point you in the direction of other advisors that can help you collate that information. And then, as Steve said, really, as a responsible lender, affordability is key. We're not in the business of lending to businesses that can't afford to repay a loan, because that's just going to put them in a situation that may end their business. And sometimes the right thing to do is actually recommend an insolvency practitioner, and we do that from time to time. I think the other thing that's probably unique about CDFIs in the lending market is when we talk about affordability, that can be forecast-led. As long as the forecast's realistic and there's a decent business plan to back up that forecast, and possibly orders to back up that forecast. A lot of other lenders will look at historical results, and if there's been a bad year but there's a forecast to get out of it, they won't lend on that basis. Whereas we're really digging to the story and then dig into that forecast to make sure it's affordable for their future plans.
I think I'd like to pick up on one thing there about declines, because the world has changed a bit in terms of the banks. I mean, when we first started, believe it or not, we used to have to get a letter signed by a bank that said that they weren't going to assist. Well, actually first of all, you mentioned about there isn't a bank on the high street. Secondly, getting someone to actually write a letter is an interesting factor. So that doesn't happen anymore. But people are discouraged. Businesses are discouraged because they think they're not actually going to get funding from a bank. They believe they're not going to get funding back, and they're probably right. But in actual fact, we actually now have got to the stage where if they say they've been to a bank, or they feel that they won't get it from a bank for the reasons that Steve outlined there, and they may be tucked away, very good reasons, by the way. They might have a bank account that had one return check on it. And some people do write out checks, by the way, just for your benefit. But at the end of the day, they are discouraged. So therefore, if they self-certify now that they've been discouraged from the bank, we will look at those as well. So I don't feel in any shape or form when I look at a proposition that basically, well, you should have got that from me. If I did feel that, I'd say, well, we've got some people in the bank. You could go to the bank. Why don't you try them first? And they might do you some, and basically we'll do the rest. We'll do the top up. That would suit us perfectly, and that would be ideal, because you've got two people look at it. Then they should get a lot of help.
So a couple of things, and then we're going to close up. 20 odd years you've been going, so you know why people come to you. As the nature of their query, in other words, why they need the funding, has that changed, or has it always been the same? In other words, I mean, do they come to you because actually they're at the last, you're the last thing that's going to keep them afloat, or is it management buyout? So has it changed, or is actually typically you can spot the reason why people always want money?
So I'd say generally most of our propositions aren't distressed.
Okay.
Even in challenging economy, there's always opportunities in the challenging economy. So we get a lot of positive entrepreneurs and wealth creators who will come to us because probably during challenging economic circumstances, as I've mentioned earlier, other lenders will tighten their credit policy, whereas we won't.
Okay.
So I think that's really important to point out that it's not really generally distressed, although, as I mentioned earlier, the distress we tend to see is when they've been to another high-cost lender, and we can easily demonstrate affordability then, but it's just whether their balance sheet's been damaged to the extent that the business isn't viable anymore. And I think probably the only thing that has changed over the last few years is CDFI support more MBOs. And we've done some brilliant ones. We had a manufacturer in the...
So an MBO is...
Management buyout.
So this is where the management team of the business decides to buy the business off the owner.
Yeah, we had a brilliant one in the Midlands who actually we did a follow-up visit to. So they repaid their loan within 2 years. Their turnover had gone from something like 1.5 million to 4 million over those 2 years.
Wow.
They'd doubled their workforce from 15 to just over 30. They'd taken on a second 7,000 square foot unit, and it just shows that, you know, if you get the next generation of business owner in, and it's someone who already loves that business, the results they can achieve, and it's brilliant when we hear stories like that. That's why we do what we do, isn't it?
Yeah, and I think the other thing that's changed over the years is that we're now lending in partnership a lot more, and not just with the banks. We're lending in partnership with other lenders, and we do a lot of joint deals with BCRS. So the deals that we're doing, probably let's say the average deal size pre-COVID for us would have been around about 35,000. Our average deal size is now near 70,000.
Wow.
Now, all right, you've got inflation to take into account, but we're doing a lot of joint deals as well, and we're actually just about to launch a sort of raising awareness of alternative regional lenders with 6 regional lenders, including 3 CDFIs in the West Midlands region, called Midland SME Finance, and it's happening this month. And that's to raise awareness, but we've done joint deals with them, and joint deals, and I think that's a way forward. But if you'd have told me when we started 27 years ago, lending to very small micro enterprises, perhaps at startup when we're doing 2,000, 5,000, that we'd be doing £1 million deal between us, which we did. And that wasn't for a management buyout. That was for a business that had got good prospects, exporting, and basically has got good prospects, but had gone through a difficult period. And we could see the bank wouldn't lend anymore.
Wow.
In fact, the bank wouldn't.
Extraordinary,
The bank, as soon as they're out of, as soon as you go through a difficult period, you mentioned the word umbrellas earlier on. Umbrellas are a feature, but if you're coming out of that difficult period, that's what we and other lenders are there to help. And yes, the bank will probably come back in when they're making multi-million-pound profits, and they'll take it. That's fine. But we've helped and we've assisted. we want to help more of those. What we don't want is those people who have got the chance to make good profits and grow. We don't want them to be going off very quickly to those online lenders and saying, well, I need that now. I'll take my 50 or £100,000 from them. And basically that puts them in a problem.
Yeah, I think that's probably a bit of advice as well for people looking to borrow money out there. Don't leave it to the last minute.
Yeah.
And I know we're all entrepreneurs. We run SMEs ourselves. There are lots of things that take up your day, but actually leaving finance to the last minute's really, really a stupid thing to leave to the last minute, because then you have got the choice of a really high cost lender that will turn it around in 24 hours. Start planning probably a couple of months before you want the finance, because then that gives you time to look at the marketplace. And I think my other top tip would be, don't get disheartened. I met a guy recently who'd, it was actually on one of our away days. We ran an activity centre, and his bank had turned him down when he first opened that activity centre, and now he does weekend breaks for Jaguar Land Rover and stuff. But because of that first rejection, firstly he was bruised, and secondly he just said, I'm never going to a lender again in my life, because he felt so humiliated. So don't feel like that, because there are other people like Art and BCRS that will be there to support you.
Absolutely. Now, that's what we're there to do. We're there to help and support, and I think we've just got to raise awareness that we are here, and hopefully more people will recognise that as we gain more money. We hope so, because at the end of the day it would be very embarrassing to be left with an awful lot of money that we can't actually use for the best purpose.
So that was the question I was going to ask you. What does success look like? So it's not money sitting on your balance sheet. That's not success, is it?
Not at all.
So what do you then, either of you, both of you, what does success look like? And then I'm going to wrap up with one last question after that.
So success to us looks like, to me, every viable small business is supported through the lending they require.
Yeah.
I mean, that's kind of the big Oxfam kind of vision of ending world hunger, because there's a big gap out there.
Yeah.
But I think a realistic thing is, at the moment our sector's small but mighty. We achieve a lot with a small amount of money. I'd like us to be large and mighty. So a bit like over the pond, CDFI is pretty much the alternative lender in the States.
Yeah.
I'd like the UK to mimic that.
Aren't they? They're a lot more mainstream. People know who they are, and they sort of scream at the top of their voices. And
So I'd like BCRS and Art to be like that, and the rest of the CDFI sector in the UK. I think the great thing about the CDFI sector is we all work collaboratively. It's not us versus another CDFI. As Steve's just said, we do joint deals. It's all about the number of SMEs we can support. Those SMEs then develop in the communities, and it's ultimately getting them into a position they can go back to mainstream finance. Job done.
It's more businesses supported, as you say. That's the thing, but it's also the stories that are going to encourage others. Once you've got that story and you can get it out there, and it encourages others to say, "Hi, they help them. I wonder if they'll help us." And I think that would be a success. The people are doing that regularly, and not actually saying, "I don't know where to go to." And that, for me, is the depressing thing. 27 years on, when people say, you go to a networking event and you say, "What do you do?" and you say, "Oh, I'm a CDFI," and they say, "What's that?" I'd like success to read that the people in the room who are going to that will say, "Oh, you're on a CDFI. I know what you do."
Yeah.
I mean, I saw it firsthand, and then we'll finish with my last question. I saw it firsthand the role both organisations played during COVID. I mean, that was just, a horrendous time. But because you had people, I'll say again, people. Because you had people that were the end of a phone and could visit people.
It's phenomenal. I think we did the third ever CBILS loan at BCRS, which is just incredible. And in the first month, we did 42 loans. We generally do around 100 odd loans a year, so 42 loans in the first. But whilst it was a horrible time, it was incredible. Like the Dunkirk spirit kind of kicked in, and our lenders really stepped up to the plate and really wanted to support as many businesses as possible.
It was a challenging time. I mean, it was recognised by everybody. You mentioned about distress and whether.
That's right.
I mean, that was about survival. That was the guarantee was 80%. Remember, and of course the government brought in, which didn't exactly help us, 100% guarantee for the smaller loans, for the bounce back loans. But we were doing it. I wouldn't like to go through that period again because some of the businesses didn't survive, and that basically is hard when you basically make a decision to support a business, even though you got a guarantee, you hope that they succeed. More failed during that period than at any time in our 27-year history. More failed, so we had more failures.
But turn it on its head, Steve.
But
more survived than failed. So that was the job of it.
Well, I absolutely. I think at the end of the day, if we hadn't have been around lending, a lot of those.
I think
failed.
CDFIs really came into their own during that period, and I think the British Business Bank recognised, as a result of that, the ethos of CDFIs more. And we did some brilliant things as well. So even though we're a really small team. We, whilst lending 42 loans in the first month, we proactively contacted all our customers. We didn't wait for them to come to us and said, have a 3-month payment holiday while we all work out what this is. Because that's the right thing. And I think that's the essence of CDFI.
Absolutely.
It's the right thing to do. Steve referred earlier, we recommend a grant if a grant's appropriate. We recommend cheaper funding if the funding's appropriate. It's about the SME getting the right funding, not always necessarily through us. But just doing that right thing for the SME.
And the silly thing is that businesses that recognise what we actually do find that there's little nuances that we don't mind if someone pays us back early, because that's what we want them to do.
You can then use the money to give it to somebody else.
We can use the money to give it to someone else, exactly. But there's no penalty for early repayment, whereas you might go to some of the online lenders and find that if you want to pay early, you have to pay a big fee, and that's not so good.
Final question. This is Muffin, and I'll sum up. Over the 20-odd years, and Steve, you did say you need an entrepreneurial attitude. Did you see finance availability decline in line with cycles of recession, or is it, in your view, actually the money's always going to be there regardless of the cycle?
So that's a... So there's two parts to that question. There's the money for us to lend, and there's the money from other lenders for the SMEs. So money for us to lend, when we were more reliant on public sector, we tended to get more money in recessions because they recognised at that point that money was needed. And I think there has been a deliberate move by the sector to move to the more commercial lending. So Steve with his... US Squared deal, and we've all been supported by social banks, Unity, Co-op, Triodos, but then more recently getting Lloyds on board and hopefully encouraging other high street banks to do the same. That means we haven't got that kind of up and down of funding for us, because we want constant funding so we can constantly support. I think if you take the SMEs perspective on it, during difficult economic times and recessions, the other lenders will, quite rightly, because they've got shareholder return, adjust their risk profile. So we actually probably see propositions during those times that we're kind of like, why on earth is this coming to us? It's
counterintuitive,
brilliant.
Isn't it? In times of recession, you're very popular because there's a restriction of funds elsewhere. It's counterintuitive.
Absolutely.
Okay, well, look, I'm going to sum up now. Thank you very much. So you're set up to help, and I'll take your comment, gap funding. So this is not particular sectors or particular characteristics. Nope. This is where there's a gap for funding. That's why you set up there. You sit nicely between the high street and the digital, and you serve that community. What makes you different is actually two things. You are people-based. You actually have people go out into their local community and talk to them. But interestingly, you also measure your success by its social impact. So this is not shareholder-driven. It is partly, but not totally. You're actually driven by social impact. Some of the advice you've given is is what probably High Street would say as well, but there's a bit of a difference, which I quite liked. Well, firstly, make sure you got a plan. So make sure you got a business plan, irrespective of who you go to. Steve, I like your comment about be upfront. There's a reason why the High Street have said no to you. So when you come to us, just be upfront, and then we know we can help you. Trust. Can we trust you? Because at the end of the day, if you're not upfront, trust comes in. Steve, you talked about affordability. That's what you're going to look at. Can you afford to pay back? You talked about having the entrepreneurial attitude and not being disheartened. And it was interesting that through recession, that's actually when you're at your busiest. So that just shows that you agree with the thing that if you're entrepreneurial, don't worry about it. There's always a perfect time to set up. Don't be constrained by cycles. Steve, you talked about we're not alone. We work with a lot of other lenders, both across and other sort of mainstream lenders as well. Typically, Steve, people leave it to the last minute.
Yep.
Don't leave it to the last minute. Make sure you come early. Don't hide under the bed. It's going to come knocking on your door. So make sure you do that. You work with a lot of advisors. So I think one of the issues has been, why it's been brilliant today to speak to you, is that people don't know how successful you are. Secondly, that you have a social impact. But thirdly, you're actually there when everybody else has shut the doors. And I think for any society to benefit and to continue to prosper, I think you are an essential part of the ecosystem. And I think the plan for today really was to make sure that people understand you're part of the ecosystem and to encourage those who do looking for funding, irrespective of the cycle, is that people like BCRS and ART are there. And very importantly, they're not at the end of a button or a click or a mouse. Actually, they're driven by entrepreneurs with an entrepreneurial spirit, but they're driven by people. So thank you very much for your time.
Thank you.
You have a valuable role to play, and long it may continue. And thanks for the cup of tea, Steve.
Yeah, you're most welcome.
Thank you.
Thanks very much indeed.
Ninder.
Cheers.